Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Mike D'Ambrosio, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate, and much, much more. And now, to guide you around the world of real estate, here's your host, Mike D'Ambrosio.
Welcome in. Good afternoon. This is Mike D'Ambrosio with Real Estate Radio Live. Thanks for joining us this afternoon. Talking anything and everything real estate as we always do on Real Estate Radio Live. Thanks for joining us today. I'm super excited. We have a great show in store for you today. Mr. Steve Hovland, the Director of Research with HomeUnion, is on the line today, not in studio. He's on the phone. Steve, how you doing?
Thanks for having me on your program, Mike.
Thanks for coming on. And so HomeUnion, their slogan is "You invest, we do the rest." So really, they're one of the only end-to-end real estate companies around that helps you invest out of state, and they kind of take you through the whole process. And we're going to learn a lot about HomeUnion today and what's going on in the markets around the country. Steve's a wealth of information on that. But before we get into that, just a reminder for those of you guys just tuning in, there's always a couple different ways you can listen to our show. That is on the radio at KDOW 1220 AM, or you can go online to reradiolive.com, or you can download all the apps that we're on, KDOW app, the iHeartRadio app, and what's the other app? We got the Real Estate Radio Live app, and every one of our shows are podcasted. So after today's show, if you want to download the podcast and listen to it again, there's going to be a lot of good info today. Or if you want to share it with your friends, you can do that. You can go to iTunes and download our podcasts after the show. And if you do want to listen live, we come to you 5 days a week. That's Monday through Friday from 3 to 4 p.m. And as you know, we are a live show, so we love to get your questions and your phone calls. And we want you to chime in, give us a buzz. That's 1-800-516-1220, 1-800-516-1220. Or you can text in to the popular text line that's 408 630-0101, 408 630-0101. All right, Steve. So let's get started here. Thanks for coming on. And Steve's calling us from down south in Irvine. So he's not calling us from back east like at his dinner time. So that's good. Let's get started about HomeUnion, about your background. Let's start there, Steve. How did you get involved with HomeUnion and kind of your background before that?
I ran research, the publications for research at a company called Marcus & Millichap. They're the largest apartment brokerage in the country. Mm-hmm. And it was exciting. It was great. I got to look at investment real estate, everything from triple net lease properties all the way up to seniors housing. So the two really big ends of the spectrum when it comes to returns. But, I thought something was missing. So I moved out to San Diego and tried my hand at surfing while still working for Marcus & Millichap, and I was really
how'd that work out?
I'm still cooking it up, but I love surfing. I love getting out on the waves. So, nice. And then HomeUnion, they found my resume on LinkedIn and found my name on a report that they liked. So they called me and asked me to come up here. Initially, I ignored them because I was loving life, and eventually they set up a meeting. I came up, and I really liked what they were doing. I thought it was new and exciting. I thought it was something that all investors should have access to, and most investors don't. So I came up here. I left my little beach cottage and came up and live in an apartment across the street from a Target so I can work a lot of hours and make this company happen. But it's really exciting to be part of a company that's democratizing the SFR market the way we are.
Yeah, so let's talk about that. So let's talk about HomeUnion. How long has it been around? What's the story with HomeUnion and where they've come to today?
The idea was conceived several years ago. Our founders I think we registered in 2009. We really launched the website in May of 2014. And we just launched a new website. These things progress and they get better over time. It's a
beautiful website too, by the way.
Thank you very much.
HomeUnion.com and we're going to give that out again at the end of the show, but it is a really nice website. Go ahead, Steve.
So the founders really, they wanted to democratize real estate. They thought that, it's largely been bounded by geography, and it's mom and pop, and it doesn't have to be, but it's very hard if you don't have the knowledge to invest outside of your market. So, we've spent a lot of money on big data and data science, and we think that that's our competitive advantage. So we analyze 110 million homes across the country,
wow.
200,000 neighborhoods, and we look at 11 different factors that go into these neighborhoods: crime rates and white-collar jobs, the school ratings. So we look at all these things, and we're able to add a risk tolerance or a risk profile to different neighborhoods. And different investors, they have a different appetite for risk, so they come to our site, and basically they let us know how much they want to invest and what their goals are, and we're able to recommend a portfolio of properties across 18 markets for them, depending on what they're after.
So, for example, an investor comes to you guys and says, I have $250,000, and here's my risk-taking level, or this is kind of how aggressive I want to be, or maybe more passive, and then you guys kind of just come up with a game plan from there. Is that how it works?
Yeah, we're looking at timelines. As you know, real estate investing, either you want cash flow, so you pay all cash, or you want to build wealth, so you take advantage of today's low interest rates and lever up.
Mm-hmm.
And there's any number of things in between those two endpoints. So, based upon what they're after and their time frame, we invest or we recommend properties for them. And it's not it's just a recommendation. It's not necessarily what they end up with. Some investors, maybe they want to be in Orlando so they can drive by their property when they go to Disney World, or maybe they're afraid of the oil market so they don't want to be in Houston. So they end up selecting the properties in the end for themselves, but we give them a head start based upon what they say they want.
Okay, so talk a little bit, because I know there's other companies out there that are helping out of state investors buy real estate. Talk about what's the difference with you guys? And I mentioned at the beginning of the show, you're really the only end-to-end real estate company around that is helping people do this. So talk about what you guys actually do to provide that service.
There are a lot of companies in this space. Everyone knows this is a big market that hasn't been disrupted, I guess, would be the term that we like to use in the tech sector.
Mm-hmm.
So, So there are listing sites, Investability and Roofstock. I don't want to plug our competitors, but those guys, they list properties. They list investment properties that are for sale. They don't manage those properties. They'll set you up with a local property manager, but they have no invested stake in the long-term outcome of that property, because once they sell it, they're out. You also have crowdfunding sites. They operate on both the debt and equity side, so Realty Mogul, patch of land, that sort of thing. And then turnkey property providers. And what they do is they buy properties, rehab them, put a renter in them, and then they'll sell them to you. And either you'll have to go find an outside property management company, or you have to, or they'll manage the property for you. So we're a little different than the turnkey sites, because what they do is they take all that value from the renovation and keep it for themselves. So after our investors select properties, they give us what's called limited power of attorney to bid on their behalf. And once we secure a property in a price range that they've chosen already, we use data science to choose where we think the price range should be. It's called the right bid offer. We look at how hot a market is. But once we acquire the property, we manage the renovation as well, and that enables the investor to retain all that value from the renovation. So that's how we're a little bit different. Is we have skin in this game from the beginning to the end. The investor's success is our success. The happiness of the renters is important for our investors. It's important for us as a company. Whereas you look at a turnkey provider, they'll put any renter that they can in there and then sell the property and walk away from it.
Right. So, okay, let's talk about the investment housing sector and what you guys are seeing in that space as far as from single family. And then do you guys help people with multifamily and apartment buildings, or is it mainly just single family?
we do have multifamily properties. We don't have them on our portal, but we do operate in that space. And the reason we do that is because we have investors that want to, place a lot of money quickly, and it's easier to buy one building with, 50 units than it is to buy 50 houses. So, but yeah, we do operate in the multifamily space, mostly in the, 1 million to 3 million range. That sector is picking up. So, but in the housing sector, the census came out in the second quarter and said the homeownership rate was 62.9%, and that's the lowest it's been since they started tracking homeownership rate since 1965. So homeownership is way down. And we look past over the past year from that same data release, there were 950,000 households formed in the country, all of them renter households. So the housing sector, the single-family sector is doing great from the renter standpoint. I mean, if you want to look back a little bit further, we looked back from 2005 to 2009 or 2015, 9 million renter households were formed in the country. That included the housing bust, but and surprisingly, 5 million of those renter households, 55 plus. So it's not just millennials and young people going out there and forming households and renting. It's older people. And
go ahead.
Well, I was going to say a lot of that has to do with the Fed and the low interest rates that we've seen over the last 8 years. They're, these nest eggs for baby boomers, when they should have been doing the most work as they're coming up on retirement, they haven't really been doing any work, other than in the stock markets. And a lot of times as people get closer to retirement, they withdraw from the stock market. So people are unlocking their nest eggs. So they have that home equity back, and they're selling their house to unlock that nest egg, and they want to stay liquid. So they're forming new renter households as they retire, and they're staying relatively liquid and being flexible.
And I wonder if some of those people are coming in and buying other investment properties, and if they're going to become more liquid based on their homeowner, their own residence, and then selling that off and buying rental properties. Is that, you think that's a piece of their retirement, or you think they're just liquidating it to, put it back in the stock market?
No, it's definitely a piece of our business. So we're seeing these baby boomers buying rental properties. They buy high cash flow, putting cash down, and they can count on that dividend every single month to come in. Mm-hmm. So when we look at SFRs and how they performed through the last recession, even though the housing market tanked and it was the last recession was driven by the housing market, rents only went down 8%. So properties continue to perform. People they were foreclosed on or short sold or walked away from their house, and they went and rented a house down the street to stay in the same school district, to stay in the same neighborhood. So the properties continue to perform. Ownership changes hands, but a payment of some part is made throughout the recession. So
definitely. Well, I think that's a great segue, and we got to take a quick break, but that's a great segue into how real estate compares to other investments, and that's kind of what we'll get into on the other side. You've been listening to Steve Hovland, the Director of Research with HomeUnion. I'm Mike D'Ambrosio. This is Real Estate Radio Live. Stick around. We'll be right back on the other side of the break.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Mike D'Ambrosio.
Welcome back. This is Mike D'Ambrosio on Real Estate Radio Live, KDOW 1220 AM. Mr. Steve Hovland is on the line today. I always like to say in studio. He's on the line, Director of Research with HomeUnion, and we're talking about investments, real estate investments, out-of-state investments, all sorts of good stuff, a lot of data. Of course, the Director of Research would have some good data. So if you have any questions for Steve or myself, love to hear from you guys, 1-800-516-1220, or you can text into 408-630-0101. And this segment is brought to you by Giorgio's Italian Food and Pizzeria and Frankie Johnny and Luigi's too. The best Italian food around with 4 convenient locations throughout the Bay Area to serve you. You can go to Giorgio's and fjlitalian.com for more information on their famous happy hour specials. All right, so Steve, we started getting into how real estate compares with other investments, and because we talked about baby boomers and them liquidating some of their housing and putting it into other rental real estate and the stock market and that type of thing. So how does it really compare to other investments?
We looked back at data gathered from the census, so not our data, but data gathered by the U.S. Census. And over the past 25 years, SFRs have yielded 7.8% on average each year. So that's 4.1% in rental yield and 3.7% in appreciation. Not to mention that the tax benefits of owning these things are fantastic. So owning real estate has a lot of great tax benefits. You can't compete with the stock market. The stock market over the long term has proven to be the most, the highest yielding investment there is out there. However, the stock market has some issues and it's very cyclical. So if you had money in the S&P 500 in October of 2008, the S&P, when Lehman and the financial markets all crashed, the S&P didn't get back up to where it was until March of 2012. So you had over 4 years of trying to claw your way out of that, whereas real estate, it took a while as well, but dividends kept coming in. So earlier this summer, we saw Brexit, and that was very hyped, and it was a big deal. So I know I was up late trying to make sense of it and what its impact would be. A lot of people thought it was going to be something that sent the world into a recession. So the bonds shot down to an all-time low. The 10-year is at 1.3%, which is that's barely at the inflation rate. Precious metals, when we look at outside of bonds, precious metals don't produce income, so I have a hard time calling them an investment. It's more a speculative play or a hedge. And then the stock market. So if we dive deeper into the stock market, we know the long-term trend is fantastic, but you don't always want to be exposed. You don't want 5 years where you don't get your money back. And the bulls have been running this cycle, then the actual economy has been growing. And the economy has been growing for 7 years now, over 7 years. So there's a lot of question out there. Is how tired is this bull market? How long can it actually run? Last year we saw a pretty weak year, 1.4% growth in the S&P. This year we're over 5%. This looks pretty good. However, when the Fed has begun an interest rate increase cycle, 17 of the past 20 times they've done this since World War II, the stock market within 6 months on either side has corrected by at least 5%. So we saw this happen last year, and so it was 16 and 19, now it's 17 and 20. Do we include this December's potential increase as the beginning of a cycle? They've never gone a whole year without raising rates once they started raising them. So I think we could see a little temper tantrum on Wall Street again. And they seem to they seem to misbehave every time the Fed looks like they're getting close to doing something. We saw it in January, saw a little bit in early September. They don't like rates being raised. So, the stock market, great investment, but if you're getting closer to needing that money, then it's not always the place where you want to have your money.
Right. Well, and I think the word for all that is volatility, right? And that's kind of what the stock market is throughout time. So, no, that's good stuff. And the Fed, the word I guess on the street is might be raising rates in the next 6 months? You think?
I think December.
Yeah. Okay.
I think that
that's gonna be interesting to see what it does to the market based on your data here. 17 out of the last 20 cycles. It'll be interesting to see what happens this next time. But we got to take a quick break. We got a lot more to get to on the other side. Steve Hovland, the Director of Research with HomeUnion, is on the line today. A lot of great information. If you have any questions, 1-800-516-1220. I'm Mike D'Ambrosio. This is Real Estate Radio Live. Stick around. We'll be right back.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Mike D'Ambrosio.
Welcome back. This is Mike D'Ambrosio on Real Estate Radio Live, KDOW 1220 AM. We have Steve Hovland on the line today, the Director of Research with HomeUnion. HomeUnion helps investors invest around the country in real estate, and they're the only end-to-end real estate company that helps you with all parts of the process. If you have any questions for Steve or myself, 1-800-516-1220. And this segment's brought to you by Starburst Construction. They've been serving the Silicon Valley for over 40 years. They're dedicated to building award-winning homes that last a lifetime. You could visit them today at starburstconstruction.com. All right, Steve, this is our quick segment, so let's wrap up. Anything, what do you think? I think we wanted to talk about raising, if the Fed does raise rates, which we obviously assume they're going to, what does that mean to real estate investors?
We do. We are expecting the Fed to raise rates in December for the second time in 8 years. It's been a very slow process for them to raise rates. But we don't think that interest rates are going to increase significantly on mortgages. They raised rates last year, and this year we set an all-time low for the 30-year average mortgage rate. And there's so much money out there, and banks have so much money right now that it's going to take a few additional hikes for the Fed to actually begin to have an impact on where mortgages are and the 10-year Treasury. The uncertainty around the globe is another factor contributing to low rates. So even if the Fed raises rates, that there's a lot of uncertainty, especially in developing markets. So we see a lot of capital flowing back into 10-year Treasuries, and that's really what sets the mortgage rates. So, right now, conditions are very favorable for investors. We think they're going to stay favorable well into 2017, probably into the second half, which is really exciting. It's really great for our clients. You can get great loans through Freddie Mac, up to 10 properties. And usually, I can't really quote exact rates, depends on the investor and the property, but typically they're around 25 to 75 basis points above what a homeowner would pay on the average 30-year rate.
Right.
So
okay. And then, very low. And then we were talking off air a little bit about the election. We have like another minute and a half, and how you think that's going to shake down. Not to necessarily ask you who you're voting for, but how it's going to affect, the market and the real estate market and that type of thing.
I couldn't tell you who I'm voting for because I don't know yet. I'm still one of those people that are courting. I'm pretty sure Orange County's decided, though, so I'm not really sure my vote counts.
All of California's decided.
Exactly. So I think that the market will react favorably to having a split executive branch in Congress. So they know that no policy will be too dramatic on either side. We're not going to see a form of Obamacare hit real estate or, anything go too crazy. So I think the market will be very favorable for that. If Donald Trump wins the election, all bets are off. We don't know what he will do. I doubt he'll deport 13 million people when he understands the economic consequences of that. So I think that the real estate market, it'll continue to chug along. It'll still be great. It'll still be great for investors. It's still going to be, very heated, especially in the coastal markets in California and back east. It's not going to be impacted too much.
Very good. All right. Well, that was our quick segment. We've got to take a break. We are going to get into which markets are the most popular among real estate investors and where HomeUnion is helping their investors buy properties. So let's get into that on the other side. If you have any questions, 1-800-516-1220. Steve Hovland, the Director of Research, is on. I'm Mike D'Ambrosio. We'll be right back.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Mike D'Ambrosio.
Welcome back. This is Mike D'Ambrosio on Real Estate Radio Live, KDOW 1220 AM, the Wall Street Business Network. And we had the pleasure of having Steve Hovland on the line today, the Director of Research with HomeUnion, who help investors buy properties all around the country. And if you have any questions, get it in now, 1-800-516-1220. You can text in to 408-630-0101. And Steve will give out the information for HomeUnion at the end of the show, and you can check them out online. And this segment's brought to you by Taps Termite. They've been serving the Bay Area for over 45 years. Taps Termite is committed to keeping your living area pest-free by using the newest and safest technology. You can call Taps today for a complimentary inspection, 408-259-5900. All right, Steve, so let's talk about the different areas that HomeUnion likes, that you like, that what you guys are seeing around there, and all that good stuff.
Yeah, Mike. So, we've kind of covered what we do, and that real estate investing is a great way to diversify your portfolio. So where do you want to do it? That's the question. That's the question our clients have. And we're seeing a lot of demand in the high job growth markets, jobs being the number one proxy for renter demand. So a lot of our investors are targeting the markets across the country that they have great jobs. And we're seeing, Tampa Bay has a fantastic job market year over year. Jacksonville was one of the last markets that came to the recovery, so they're really catching their stride. Dallas has added the most jobs in the country over the past year. Surprisingly, they are not as exposed to the oil sector as Houston is. In fact, they have a very small exposure. Exxon's headquartered there, but all of their jobs are actually in Houston. It's just a small headquarters in Dallas.
Yeah.
So Dallas has been.
What are some of the companies that are driving? Are there big companies coming into Jacksonville and Tampa Bay, or is it just natural job growth of other smaller firms?
When we look at Jacksonville, one of the things you have to talk about is the military bases there. They have a huge military presence. It's the third largest in the country, behind only Norfolk and San Diego. And there's been talk of actually moving an aircraft carrier or two from Norfolk down to Jacksonville. That's going to get caught up in Congress because Virginia doesn't want to lose those. That's like 3,500 sailors and 5,000 jobs. It's a lot to lose something like that. But Jacksonville is getting more what they call littoral ships, or they're the smaller ships that are replacing the frigates. So they just got a bunch of those. So the military is expanding there, and that's a great source of renter demand. And Tampa Bay, you have MacDill Air Force Base nearby, and that's got a huge economic impact. So we're seeing that, but you're also seeing a lot of leisure and hospitality jobs popping up in these areas. So that migration of retirees from the Northeast back down to Florida has resumed, and all those jobs that support that are being created.
Okay. And so what type of returns are we looking at in some of these markets you've been mentioning, and average pricing and rents and all that type of stuff?
So we're looking at something like Tampa. We're seeing average cap rates. So an investment home, the median investment home price is about $127,000 in Tampa, or was there in the second quarter. And the average cap rate was 6.7%, which is your first year return. That's a stellar cap rate. Jacksonville was 6%, so not quite as high of rents, but prices are real similar. We see Dallas dips a little bit below, with 5.8% cap rate. Prices run up to about $170,000. Some of the other popular markets, Oakland is a popular market. We're not active in Oakland, but it is popular for Bay Area investors. But the median investment home price there is almost $500,000. So, and you're making 3.4% return on your money there. So we don't have a lot of investors that like that, but it's popular with some Bay Area investors, particularly ones that wouldn't use our services and manage on their own. But most people don't have $500,000 to buy an investment property sitting around.
Right, and then and I've talked about it on the show before. The thing about buying, especially properties in California or New York, is the rents aren't going to be that much, from the pricing of $127,000 in like a Jacksonville as opposed to $500K in Oakland. That difference is not going to be reflected in the rent difference. Am I right?
Very much. So we have average rents of $3,000 in Oakland. for that 500,000, or no, I'm sorry, that's the market average, 3,000. Or in Jacksonville, you're paying 127, you're making 1,400. So you can buy 3 properties and still be underneath that 500,000 number in Oakland, and have much higher rents, getting a lot more revenue coming your way.
Exactly. So talk about what is for someone out there listening today, what does a typical investor look like with HomeUnion? They call you guys up and say, hey, I got this amount and I'm looking for this. What does your typical bulk of your investors look like?
We have a wide range of investors. We recommend at least $50,000 to begin investing in real estate. We're not a flipper or a fix and flip company. So when our investors come in, they come in with at least $50,000, and that's to lever a property up, and you have to hold a little in reserve. We manage the property, but the investor is still responsible for the maintenance on the property. So most of our investors have more than that. Our typical investor comes in with well over $100,000, and they're looking for 2 properties or more. More than half of our investors, and this number continues to rise, but more than half of our investors, they come in and they buy additional properties down the road. They want to feel it out, make sure everything is on the up and up, and that the property performs as we said it was, and they'll come back and buy additional properties. So, it's high net worth people. I don't know about high net worth. We're not talking accredited investors where you have a lot of liquid, but it's not cheap. You can't get into real estate for free. So, despite what some people
that would be nice.
Yeah, right. So,
go ahead.
I was going to say, but the interest rates are really low, so it's as free as you're going to get to borrow money right now.
Yeah. And you did mention before, and a lot of people get it confused as far as finance properties as an investor. How many can you have, finance? And you were saying through Freddie Mac you can get up to 10 properties financed, whereas a lot of people think it's 4. So it can be 10, right?
It can be 10. The down payment goes up after 4. So it's usually, I believe it's 25% approximately for the first 4, and then they ask you to put more skin in the game for the other 6. But you can get up to 10 properties financed through Freddie Mac. And then the hard money lenders, banks that are out there, you can get properties, loans through them for how many ever properties you can afford.
Yeah, but it's gonna cost a lot more than
It will cost you a lot more, but you can get loans through them based on property performance rather than your own bank account.
That's true. That's very true. All right, we got to take a quick break. We're going to come back and wrap up the show. Steve Hovland, the Director of Research with HomeUnion, been on today. A lot of great stuff. Really happy to have him on. I'm Mike D'Ambrosio. This is Real Estate Radio Live on KDOW. We'll be right back.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Mike D'Ambrosio.
Welcome back. This is Mike D'Ambrosio on Real Estate Radio Live, KDOW 1220 AM, the Wall Street Business Network. And we've had the pleasure of having Mr. Steve Hovland on the line today, calling from Southern California. He's the Director of Research with HomeUnion, and they help real estate investors invest in real estate around the country. So, Steve, just to kind of wrap up the show, let's talk about the future of, what does the future of real estate investing look like?
I think it's strong. There's 16 million single-family properties out there, a lot of them mom and pop owned. But we know that these geographical boundaries, they're not permanent. And technology and companies like HomeUnion, we're going to help break that down, and we're going to see, I think, more capital flow from the coast into areas where investing makes sense. So from the investment side, SFRs are strong. I think it'll be a more important piece of a diversified portfolio over time. And there's so many advantages to them that I don't think investors will stay away once the process is easy like we're trying to make it. From a renter side, I spoke earlier about the home ownership rate being at an all-time low. when we look at the future of home ownership in this country, and a survey or a study by the Urban Institute, so it's not our data, but we happen to agree with it. What they did is they broke down and looked at, what kind of households are going to be formed, and their forecast from 2010 to 2030 was 13 million new renter households. We could eclipse that very easily, and a lot of that comes from the changing demographics in the United States, and these households, the demographics of new households are going to mirror the demographics of the U.S. and how those are changing. So we're seeing more minority households forming, and minority or immigrant households don't have the accrued family wealth that enables them to, invest heavily or buy homes or pass homes on to the next generation. It's going to take a couple generations for that to happen. So, we see the homeownership rate ticking down to like 61% by 2030, maybe even lower.
I wonder if it also has to do with maybe the millennial generation with student debt and all that it's going to affect their purchasing power as well, and probably create more renters too. For
sure. Since 1995, tuition has tripled at public and state colleges. So the debt burden on millennials is dramatic. And
yeah, it is.
So
definitely dramatic. All right, we got to wrap up the show. We just got like another 45 seconds. Steve, really appreciate you coming on, and they can look at all the information on HomeUnion, HomeUnion.com, right?
HomeUnion.com.
All right. Hey, Steve, really appreciate you coming on. Thank you.
Thank you, Mike.
And thanks for tuning in, everyone. If you want more information about Real Estate Radio Live, you go to reradiolive.com. You can email me, Mike, at reradiolive.com. And if you have any other questions or comments, you can go to my website, www.mikedsells.com. That's mikedsells.com. Or facebook.com/MikeDRealEstate. Thank you so much for tuning in, everyone. Have a great week, and we'll see you soon. Take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit reradiolive.com. That's reradiolive.com. Tune in, log in, download our podcast. Discover more at reradiolive.com. reradiolive.com.